Hey, this is Kevin Gormley, CFO of Leading Edge Financial Planning. And again, a thought experiment. You know, I love these thought experiments. Try to figure out a way to teach us about markets. And when I say us, all of us. So this is Charlie Mattingly, CEO of Leading Edge Financial Planning. Charlie does have a new pilot page, which is really quite excellent. It's even got streaming airline news on it, but this is part of our website. So let's just say for a second, Charlie can fly a plane at, I don't know the speed, so fast. I mean, I learned this in Superman, so fast that he can go back in time. So it takes us back 10 years to 2006. And we all sit down with you, and you are in your early 40s, and you say, I don't need the money for 10 years. I want to invest real aggressively. I want to get the best returns. Can you guys help us? And we do a financial plan as well as an investment plan. And we decide, yes, we're going to put your money in a very diversified, just stocks though, but very diversified mutual funds and really spread your money out. And we're going to invest. Here's the regions of the world. We're going to put 67% in the U.S. because at that time it was about 48% of the markets were investable markets were in the U.S. and the rest in the world. And we say the stock style, we're gonna go a little more value, we're gonna go a little smaller. But even if we didn't do that, it wouldn't make a difference for this. But we're going to build a portfolio for you. And here's the expenses. It's going to be less than 1/4 of 1%, and we all feel terrific. So now we're going to take you through time and come really back to the future, if you will, to use that expression. And we're going to look at the way that investing feels in a more, I'll say real time, but it's really history here. But we use the past because that's the only way we can know what actually happened. So let's go through it, and I'm going to show you the returns and what it might have been like for you and for us to manage you through, not manage you, but manage your investments and as well as your emotions through the next 10 years. So on 9/13, the market's up a little bit. And then let's look at 9/14. Let's just go the first 2 days. And okay, so up 0.3. At the end of the week, you're feeling pretty good. You say those guys must know what they're doing. And then next week, the next Friday, ooh, all of a sudden we're back to almost even. Start to question, maybe I don't like this investing. And then the following week, everything is good. So now we're going to go month by month. So let's go to October of 2006. We go to the end of the quarter. You're up 5.62. This is great. Made a great decision to invest. I'm really happy I invested. And then we come over to November 6th, another month later. Man, I like investing. It's really, really terrific. And the only reason you like it really is because you got lucky on the time period. So now we go to the end of the year. So 12/29/06, you're up 11%. This is what's supposed to happen with equities. Now let's wake up because we're in a time machine, if you will. Let's wake up on 2007 and check out what happened with market returns on December 31st. Okay, we're up 13%. Beautiful. Let's go to '08. And now I'm just going to go by years. So we go to '08 now. This is where it starts to get interesting. And we go to December 31st of '08. We are down 32, 30%, something like that. Okay, so investing is not much fun anymore. And why didn't those guys, why didn't I see the crash? When I say those guys, us, Charlie and I, why didn't we see the crash? Why didn't you see the crash? Oh my goodness. Our retirement is devastated. But let me remind you, we said that we were going to wait 10 years to judge this thing. We didn't say we were going to judge it every year. We said, what's your goals? What's your financial plan? And you said 10 years. And so now we're all judging it, and we feel terrible too, by the way. We're all judging it in short periods of time, and we feel awful. Now let's go over to the following month. Let's go to January. And again, this is during the Great Recession. This is the pain. Down a few more percent. Now our spouse is really worried. We check our statements not just daily, but we look at our statements every day. Now we get to February 27th, and we are down 43.76%. This is a miserable, miserable experience. All this stuff about investing. So right now we have a decision to make. Do we continue to invest? Maybe we fire the investment managers. Maybe we just pull out and get out of stocks and say, because right now, all the news that we hear every single day is that the country is going to hell in a handbasket. Markets are frozen. The markets may never come back. This is the next Great Depression. We're hearing all this stuff daily. If you don't remember it, I remember this very well. Believe me. This was my second year as an advisor. I remember this extremely well. So now we go into March. We go to March 8th. Actually the 6th. This is the bottom. This is the bloody bottom, 47 point something percent down. Now, if we sell, if we feel terrible, if we feel embarrassed, if we feel, oh my gosh, I should have seen this coming, and we sell, we sell at the bottom. Now, the majority of people don't sell at the bottom. People say, I might sell, and then the following week, the market came back up. And then the week after, market came back up a little bit. Maybe things are better. Maybe things are better. So now let's look at June. Let's go halfway through the year. So it's June 30th, and we're still down 34%, and you come in and meet us again, and we're all kind of depressed, and things are really looking bad. And yes, it's come back a bit. Maybe it's time now to get up. Maybe get out. Maybe it won't continue higher. But we convince you you're going on vacation next week. We convince you to wait just till the end of the year. We tell you, let's wait till the end of the year and let's see what happens. So we run through 6 months, and you're still checking your statements every day. Oh my goodness. Market's almost back up to where it was when we began. And so you come in and you say, Charlie, Kevin, I'm going to sell once I get back to even. I don't want to do this anymore. And we tell you, I know this is hard. We hate it too. Everybody's upset. Don't do it. Let's just wait. So you agree that we'll meet again in 6 months. Okay, so 6 months later, June 30th, 2010, market crashes again. And you say, guys, I told you we should have sold. You guys are idiots. We have a good relationship now. We've spent a lot of time together commiserating. You guys are idiots. Once again, we tell you, no, let's not do anything. I know we want to do something. Let's not do it. Let's wait another 6 months. You agree, but you continue to check your accounts every single day. And if you're starting to see a pattern about the grueling amount of checking that you're doing, this is real life. So now all of a sudden, we've been through the worst. We're now back. You really want to sell again. It's December 31st, 2010. You tell us, hey, you call us that day. You say, hey, Happy New Year to you for 2011. We got to sell the first day of January. And again, we say, we don't want to. Your goal was 10 years. Your goal was 2016. Let's not sell. And so now let's go to the next year. Let's go to 2011. You call again to wish us Happy New Year. At least we're still friends. And on the 30th of December, market went back down, got cut in half. So you say Happy New Year, but I really hate you guys. And then the following year, 2012. And 2011 and 2012 were awful years as far as how the markets went up and down. So market's back up. 24%. You say, all right, hallelujah, I got a 3.5% return. I want to get out. And we tell you, remember your goal, remember your financial plan. And you say, you guys are just doing this because you want to keep our money under management. You guys are not really, you really don't care about me. Maybe we're out having a drink or something and you're talking very freewheeling. And then in December of 13, after the greatest year we've had in many years, all of a sudden, you're like, guys, you come to us, like my brother John said, forgive me, John, but I'm so glad we had the guts to hold on during this time period. That actually happened. And now you're up 61, I think it's 61, yeah, 61.7%. Sorry about that. So now you're up almost 7%, and you say, okay, that's it. I'm getting out. And we say, you look, we kind of agree with you. We think the market is too high. It feels too high. We just had the greatest year in history. Let's consider getting out. But I'll tell you what, let's wait until next month, and we put you off for a month, and then we can't meet you because my aunt got sick or something, and I need to go up to visit my family. And somehow we delay you from selling till 14. Now, what ended up happening in 14 was not very much. 14 wasn't not very much. Let's go to 15 now. Now you're starting to get the fact that let's just stay invested. You're still checking your account every single day, which I don't know. You think it gives you a sense of control, and in 15, market rolls back over. So now we come in, and it's today. So we have a 10-year history, and this year actually, right today, and now we're back to the future. We're back to the present. Today, the market's actually at your account value is actually at the highest amount it's ever been. And so the point here is not to say that we're so happy that you got a 6.27% return with equities, with 100% equities. And you had to ride this roller coaster and all these little roller coasters. The point is if your goal, we really have to do a better job as financial planners and advisors to say, this is your goal. We are not going to do anything if that's your goal because we know markets are volatile. That's the key. That's the key thing. Now, will there be another crash? Now we're looking out in 10 years. I think there absolutely be another one of these crashes in the next 10 years. I think it's coming. It could be tomorrow, could be next week, could be next year. It's coming. What are we going to do when the next crash comes? I hope we'll go back and we'll think about what we did last time, and we'll just hold on. And, a 6% return, that sure beats getting a 1% return in CDs. And I do realize that you could get more than a 1% return if we went back to the past year. But investing is all about sticking with it. And maybe if you dollar cost average during this whole time, if you were truly 40 years old and you didn't put any more money in, imagine if you dollar cost averaged all this time, every week, you would have tremendous returns, probably 10%, I would bet you, because again, the market's at the highest it's ever been since we started. Your portfolio is at the highest it's ever been. So I'm Kevin Gormley, CFO with Leading Edge Financial Planning. Sometimes we have to change the way we think about investing. When markets go down, it's not the end of the world unless we need the money today, and then we shouldn't be in markets anyway. So thanks for watching.